right. How's it going, everybody? My name is Tristan Gelrud. I'm an undergraduate student, and I study physics. Particularly, I study nonlinear dynamics. A few other things, but that's just mainly what I'm very vocal about and have gained a bit of popularity with in terms of a specific theory that I've been working on over the past year or so. But specifically, my theory has to do with the financial markets, and it has to do with natural symmetries in which can be found and could be analyzed and forecasted upon. So this video is going to be a little lengthy. I'm guessing it's going to be anywhere between 1 to 2 hours long. Now, I will have timestamps in the description. I will be breaking this video up into a few different parts. First, we are going to be discussing the theory at hand. I'm not going to dive into freaking everything and just go full blown with all mathematics and all this crazy stuff. I'm just going to give you a very simple rundown of the basic principles of the theory, and then how the theory actually derived the projections that I'm about to show you. So once we discuss theory, we're going to talk about a few different caveats on some things that I've posted about to kind of clear some things up, some misconceptions. And then we're going to jump into a very, very important piece regarding definitions. This is a part that everybody should watch. It is extremely necessary that you understand the definitions of before moving forward. And then once we cover the definitions, then we'll get into actual charts and we'll get into the step-by-step framework. After doing the step-by-step framework, I'll run through a few different examples so that way to show you guys some consistency. And then after that, well, let me look at my notes. After that, we are going to be then covering a few different topics regarding the projections. This is also to clear the air on some things that you will see. I will give you a sample top-down analysis. And then we will be going through a couple different use cases for these projections. How can these actually legitimately be used in a mechanical model? Super simple, nothing super crazy. Very, very simple, mechanical, straightforward, logical. We'll go over finally some issues that you will encounter, right? When/why might a projection not work, what you can do about it. We'll go into how you can keep your charts clean, because these projections can generate a few lines. So we want to make sure that everybody's keeping their charts clean, and we could also read each other's charts if we're posting about it. So we'll go over a few abbreviations for things as well. And then finally, we'll go over what you can do to participate in building these projections further, right? There are ways that they can be improved, 100%. And I will go over those methods. And if this is something that you would like to contribute to, I welcome you with open arms to do so. So all of that I just stated, I will have timestamps in the description. But all of this is basically to cover a Twitter thread. I am recording this video before I have posted this thread. This thread will be a little bit more, since I'm writing it, I'm actually able to get specifics down and kind of rehash what I want to say and make things come out a little bit better and things like that. So what I'm doing currently is all live. I am not doing any cuts. This is all straight live, right? So you're going to be, if you read the Twitter thread and if you watch this, you're going to be getting the same idea, but explained in two different ways. So that could be helpful for people who try to read the Twitter thread, can't really put some things together, so then they come over here to the video, and then you could confirm or, just figure out exactly what I'm saying, right? Exactly what I'm describing. Try and backtest. I cannot make that any more clear. This video, this is me going over my theory. This is me going evidence over my theory. This is me going over a framework for interpreting my theory and for utilizing it in the actual markets. However, this is all of my work. The way that I see the markets is going to be completely and utterly different from how each and every one of you who are viewing this video will. Therefore, it is extremely important that everything that I claim, you backtest. Do not just listen to me, right? I could be lying to you, right? You must backtest. Everything that I give you, everything that I show you, confirm it yourself. Do not backtest it to confirm it correct. Backtest it to prove it false. That is how you should be going into this. Backtest everything that I say in an effort to prove me wrong, right? That is the entire basis of peer review in science, right? I submit a theory, you go over the theory, and you look for any holes in it, right? So I'm going to submit something that I've been working on, and it is your job. Well, it's not your job. That's a bit of a harsh word for this. It is your opportunity to take part in an open source peer review of what I'm about to show you. Now, the theory is not necessary for the framework at hand. If you do not want to learn the theory, you do not have to. The theory is there as a method for interpreting what is happening in real time. It is there to help improve the framework further. These projections could not have been developed without the theory, and they could not be developed further without sticking within the boundaries and guidelines defined by the theory at hand. So, if you are just looking to use this to implement in your trading strategy, then the theory is not necessary. If you choose to listen to the theory, then by all means. But if you choose to skip ahead, you may do that as well. This is what the timestamps are for. I would rather you skip ahead than to click off the video. So please, if you do not want to get into the theory, this is your last warning. Please skip ahead now. Okay. Let's dive in. So first I will bring you to a paper. This paper was posted in December of 2014, basically beginning of 2015, very last day of the year, by Adam D. Clark Joseph, and it's called Exploratory Trading. Now, this paper is extremely crucial in everything that I'm about to describe. But to put simply, so on Twitter, I am very well known for discussing I love that picture, for discussing physics and finance, combining them into econophysics, right? Like I said, I've been working on a theory over the past year. I've been very vocal about this theory, and if you go to my highlights tab, all of my threads are in here. I do post in threads. This is mainly what I post, but they are not your usual threads. I will tell you that much. So to give you an idea of what this theory is about, previously I posted, where'd it go? Where did it go? Right here. So previously I posted a thread and I posted a paper. This was an informal paper. It's not an academic paper. This was a paper that I created specifically for my Twitter audience and for people who are who have no background in science, right? And within this thread, there's over 50 examples across 20 tickers and 8 timeframes of evidence of the symmetry that I'm describing. Now, this symmetry, specifically, I believe that the financial market is intermittent, meaning it is constantly, periodically switching between 2 states or more. But the 2 states that I've mainly identified are stochastic, which is another word for random, right? Entirely based on probability. And deterministic, right? Which is another word for predetermined, right? Entirely based on certainty, not probability. So when you are dealing with deterministic systems, think of a ball, right? Think of a ball rolling down a hill. Now, this ball, you're looking at it second by second, right? Each second individually. Now, within this 1 second, it cannot go from this position on the hill to suddenly the other side of the hill, right? It cannot just go to the other side of the hill randomly, right? The ball, it only has, based on its prior position, one place that it can go, right? Based on its momentum, its velocity, gravity, mass, lots of different factors, friction, lots of different factors that might play into how this ball is rolling. But when you combine all of those factors, if you were to know each and every value, and you were to do the math and figure out the equation for how this ball is moving down this hill, you would get one output, right? You would get the next position, and it would be, well, predetermined, right? It would be predetermined based on its prior state, right? If the ball was there, it is now here. The ball cannot be on one side of the hill, but then in the next second be on the other side of the hill, right? Instead, it could only be, you know, where it can be 1 second from now, right? If it's moving down the hill continuously. So that is determinism, right? And stochastic, like I said, is just random, like randomness. Think of like particles moving, right? Bumping around into each other is just a very random Brownian motion process. So when do these states occur? Well, for stochastic states, you can mainly think of economic events, right? Economic events, whenever economic data drops, people are hedging bets. People don't know what the data is going to be, but they can make an educated guess. And even though they can make an educated guess, doesn't mean that they do. You see, not all investors are rational. Many investors are irrational. They'd are very low intelligence traders, but then you also have the side of the market that is very high intelligence. So you have a mixture of rationality, irrationality. You also have a mixture of human and non-human perspectives, right? So the market in these periods of when new economic data comes out, everybody is placing their bets, and price will tend to move very aggressively. It will tend to be very, very volatile, very unstable, right? Almost like there's no path to where it's going. It'll go all over the place, really. This is what I define as a stochastic state in price, right? And whenever you're trading within these states, you are trading entirely based on probability, right? You could make as educated of a guess as you want. You will never have a 100% certainty of getting it unless you somehow have the data early, in which case you are entirely dealing on probabilities. Now you can make a very educated guess, right? You could be a guess could be 99.9%, right? However, you're still dealing with probabilities. So that's stochastic price action. Deterministic, I believe, is, well, everything else, to put simply. So let's break all of this down. Let's go step by step. And to begin, we're going to define the market. We're going to define exactly what the market is. Well, roughly what the market is. That's the whole beauty of this theory, is it's not specific because it doesn't have to be. It is built around generalizations. And it does this through something called logical induction, which is breaking things down into its most finite and fundamental elements. Now, what is the market? Well, the market right now is running on a bunch of servers across the world, right? So it is a network. To put very simply, it is a network where there are participants transacting with each other, right? So participants are utilizing liquidity to communicate basically with each other, right? Participants are acting on liquidity within a network. Participant could mean a liquidity provider or a market maker. It could mean a high frequency trading firm, a hedge fund, a professional firm. It could mean a central bank. It can mean an algorithm, an execution algorithm. It could mean a hedge fund algorithm, a high frequency trading algorithm, a central bank algorithm, or it could be a retail algorithm. All algorithms are going to be non-human actors. But what anybody who participates in the market, anything that participates in the market, is defined as an actor. You could divide actors into human or non-human actors. But all the actors are placing orders, and they're acting on price as a function of liquidity. And this is due to the market makers. Now, if you are aware of the NYSE market model right here. So the NYSE market model, it makes up designated market makers. You also have supplemental liquidity providers, right? Supplemental liquidity providers. So market makers are obligated to provide liquidity to the markets, whereas supplemental liquidity providers are not. They're not obligated. Rather, they're incentivized, right? But they are not obligated. Anybody who is a supplemental liquidity provider can stop giving liquidity to the market at any time they please. And this is mainly what supplemental liquidity providers will do, especially during flash crashes. Supplemental liquidity providers tend to get out of there. But designated market makers are the ones who are always providing liquidity to the market, and they are doing this by pre-purchasing positions at both bid and asks in line with the NBBO. And then that is when they are acting as an intermediary, and they are selling to willing participants who want to buy at X price that the market maker sets. And they make a profit based off of the spread of when they originally bought it from when they now sell it. Right, so that is what the market makers and supplemental liquidity providers are doing. And that is how price is a function of liquidity. That's how we could define price as a function of liquidity. Because what market makers are doing is they are basically quantifying the elasticity for the demand of orders to what's already supplied in liquidity. Right? So you could then define price as some function of liquidity that is governed in part by liquidity providers and, of course, federal regulations, which we will not get into. But to put simply, this relationship is very complex. There's a lot of moving parts here, right? And not to mention, there are so many factors that we haven't discussed, such as the option markets, right? What about futures, bonds? What about stocks, right? If you have the S&P 500 and futures and options and then stocks, if I buy options, it's got to have an effect on the price in some way, right? Like, these are all factors that contribute to the movement of price in some way, some shape, some form. And the way that I've gone about this is it's too much to even quantify. There's no way to put together all of those factors. So you can make as many guesses as you want, but you're not going to come close to getting a precise market model if you try to replicate how price is mathematically formed. Right. But what you have here is complexity. You have a complex, difficult, crazy relationship between participants and the network who are acting on liquidity and orders. And this all fits in line with something called actors' network theory, right? It's a very simplified way of viewing complex systems such as these. And it basically splits it up into three parts of the actors, the actant, and the network. That's what we have done, is we have used actor network theory, and we have subdivided the market into three main components of the actor, the network, and liquidity. Now, as I keep putting emphasis on, this relationship is complex, and the reason why I put emphasis on this is because through complexity, chaos will naturally emerge. When we look at the history of the markets, when electronic trading began, right, when the entire market was turned into some electronic tool, right? It was turned into an algorithm, right? When we look at how that was done, nobody has to code chaos into how prices form. Nobody has to manually intervene to make chaos appear in the markets. And this is the beauty of the theory, because chaos is naturally emergent within complex, nonlinear, and deterministic systems that exhibit characteristics of the butterfly effect, or sensitive dependence on initial conditions. So the butterfly effect is inherent to chaos theory, right? Basically everything I've described thus far, I've stated that the market is intermittent between stochastic and deterministic states, right? I've stated that it is very complex. There is a complex relationship appearing here. And the market is also nonlinear, right? If I were to buy a position today in Apple, for example, and then I were to buy a position tomorrow, right? I bought one position today, I buy one position tomorrow. The position I buy today is going to have a completely different outcome than the position I buy tomorrow. Therefore, the effect of the market is nonlinear. It's a nonlinear relationship, right? I could input 1 today, and I could input 1 tomorrow. However, I will not get the same output today or tomorrow. There will be 2 different outputs. So therefore, the market is nonlinear. The market is moving between stochastic, deterministic states, and the market is complex. Through this, we can say that there are a generally good amount of conditions for chaos to emerge. So, let's take a step back. Let's go back to this paper about Adam D. Clark Joseph. Let's talk about the exact role that these high-frequency traders and supplemental liquidity providers are taking, because it's actually pretty important. Really, any actor in the market, any participant, they are entering the market on their own obligations. They are entering the market based on their own needs, their own necessities, their own wants, their own vision, their own goals. All actors, as I've already stated, They are irrational and they are rational. There is a mixture. You will get multiple different outcomes of this. And therefore, you can never really say that the market will always move in this manner. Now, what you can say is that actors will do what they can to come out on the winning side. At least the rational actors will. Irrational actors, however, they may not. They may not even realize that there are ways to come out on the winning side, but rational investors do, right? And these rational investors you could think of as professional firms, you could think of as high frequency trading firms, you could think of as hedge funds. And what they are going to do as a rational investor, they're going to look at how the irrational investor trades, and they're going to learn. They're going to figure out what they're doing wrong, and they're going to do the opposite, right? Just as anybody does as you are learning to skateboard. You go to the skate park and you try doing an ollie, you try doing a kickflip, and you don't get it. So you look over and you look at the other guy who just did a kickflip, and you see that he flicked his foot a little bit different than you did. So you flick it forward more. And you repeat that same process 3, 4, 5 times. Maybe you do this over a couple weeks of going to the skate park. And finally, through watching the other actor, you're able to learn. Maybe you watch the actor who could do it better than you, but maybe you could also watch the actor who really kept failing. Regardless, over time you learned and you implemented your own system, taking input from both scenarios. This is kind of what high frequency trading firms and professional trading firms and hedge funds all like to do. They like to analyze what's occurring in the market. They like to analyze the dynamics, all the perspectives that are emerging, all of the orders that are coming in and out. And they like to say, okay, how are people looking at this event? How are people looking at this action? And if they're able to gauge that psychology well enough, they will take advantage of that. Now, they do this through, as Adam D. Clark Joseph has shown, they do this through exploratory trading. Now, I've already explained what the job of the market maker is. But, as I've already said, there's 2 different types of market makers. There's the supplemental liquidity providers, and there's the actual designated market maker. The designated market makers have to be there. They are obligated. They are completely and utterly regulated to do so, to provide liquidity, whereas supplemental liquidity providers are not. They can leave at any time they want. They could trade on their own accounts. They could do what they please. They are only there to help in times of stress and need for the market maker. Whenever orders become too great and they pile up and the market makers cannot take everything themselves. So, being that market makers are obligated to be there, market makers have some level of information, valuable information, privy to future trajectories of price. Market makers, they have tools, right? They have tools, they have things that retail traders and even professional trading firms and hedge funds, and they don't have, right? Now, lots of these tools are going to be liquidity and order flow analysis tools. And this is exactly what the supplemental liquidity providers, that's explained in this report, are looking to get a hold of. They are looking to study this superior information, this liquidity analysis and order flow analysis, right? They're looking to study basically the levels of liquidity at a specific level of price. And they do so through exploratory trading by placing random trades into the abyss of the market. They'll place it way up above where price currently is, way below it, right? Way just all over the place, way away from wherever price is now. Orders that are doomed to fail. However, they do these completely knowing that they're going to lose money, but they do it so they could gauge the liquidity at that level. Once they're able to come to a gauge, they are able to extract and, put together a trajectory for how far price is able to achieve. Once they have that trajectory through exploratory trading, they then engage in something called momentum ignition. Now, momentum ignition, basically, if I were to pull up a chart right now, hold on, pull up this. If I were to pull up a chart right now, momentum ignition is basically this action. Price comes up or comes down, then it goes up, then it goes down, and then back up again. And then goes directional. Right? You could simplify it even more so to you have a consolidating range. Price goes up, down, and then up, and then continues. How is this momentum ignition? Because what momentum ignition is it's a high frequency trading strategy in which takes advantage of the psychology of breakout traders. Simply put, a breakout trader sees a breakout occur and they buy. But then the high frequency trading firm sells. Bring price in the opposite direction below this low right here. The breakout traders then say, okay, maybe price is reversing. So then they start to sell. But what did they just do? They just sold their positions back to the market makers at a discount willingly. And they just took it back up. And they're now going to target what they just did through this impulse right here, this momentum ignition impulse. What they just did right there was they just collected liquidity. They collected liquidity. Now you could think of liquidity as like the gas tank for price. Price doesn't move if there's no money flowing in or out of the market. price moves, the more money is flowing in and out, right? So you need money, you need liquidity, you need orders for a trajectory. All right, so what they are doing, high frequency trading firms, as shown in this report, is they're engaging in momentum ignition after exploratory positioning, right? And once that is basically, that occurs at the beginning and end of every single trajectory. Every single one. If it's not happening on your time frame, it's because it's happening on either the one above you or the one below you. But at the beginning and every single the beginning and end of every single trajectory, momentum ignition does occur. And this is the basis for this model, this framework that I'm about to show you. All right. Now, before I continue further, let's summarize what we've already gone through. Right? The market, it exhibits characteristics of stochastic and deterministic systems. It is nonlinear, right? And it is made up of three components, or the network, actors, and the actant, or liquidity being the actant. This relationship is complex, which gives rise naturally to chaos, right? Now, this complex relationship, there are rational and irrational participants, and each one has their own values, their own ideas, their own goals, and they will each try and take advantage over the other, right? Because for every time somebody takes profit, somebody else has to lose, right? So this is a game. This is a win-lose game. And therefore, you are going to be having people participate and try and take advantage of each other. And that is exactly what we see here. Now, as I've already stated, all the factors that contribute to the total, the continuous movement of price cannot be quantified. It is too much. This theory is not a theory of cause. I am not telling you what causes price to form. Rather, this theory is a theory of effect, where I analyze price after the cause has occurred. I analyze the effect that takes place. Right? And that is what chaos is. Chaos is an effect of something. It is a result of complexity. Now, I've talked a lot about all of this on Twitter. You go through all of my threads. Right here, there's two things that you see in this GIF. There is the logistics map, and there is the Mandelbrot set. Now, most people don't know this, but the logistics map is actually part of the Mandelbrot set. The Mandelbrot set is a symbol of fractality, right? Fractal nature, right? Kaleidoscopes, things like that, right? Infinite fractals. The logistics map is a symbol of chaos. However, they are intrinsically connected if you were to actually model the two, right? The logistics map is on the far left-hand side, and, you know, the Mandelbrot set is that whole orange piece that you see right there. You could zoom in infinitely and see the same thing at every level of magnification. But then for the logistics map, you see that over time, things become chaotic, and then you see those gaps, those areas of nothing, and that is order, right? So it's basically hidden order amongst something that looks random, right? And this is what I'm saying has emerged from this complexity. Now, it's a little bit hard to visualize. So think of it in the way that I've described in this thread right here on price and particles, which again, you can find in my highlights tab. But in here, there are lots of GIFs. You have basically particles all in a simulation, and applying simple rules to each of these particles, you could generate structures that naturally form, right? And so as you can see, all the particles are coming together, and the movement of each particle, if you were to analyze each and every particle individually, you would probably say, this is random. This looks crazy. But when you zoom out and you look at the bigger picture, what you can actually see is that there is hidden order. There is structure to how all of these particles, this crazy mess of particles, are behaving. Right? So you could visualize this through this right here. As you can see, bam. So just like that, you are able, with just 3 simple rules, you are able to get very interesting and chaotic dynamical systems that naturally emerge. You are not coding all this to happen. You are just applying very simple rules to a color matrix. Right? So this is a very good way to visualize what I'm saying is occurring, right? I'm saying that you have all these individual participants or particles that are placing orders, but all of their orders are naturally, when you break everything down using logical induction into finite components of rational, irrational behaviors and non-human and human participants, you could get very generalized and emergent structure and price to form like what you see here. So this is the basis of the theory. This is the whole idea behind it. And this idea says that there is a natural symmetry to how price behaves. So right here, the projections I'm about to show you, they are going to be very similar to how you might use standard deviations. This is not a full-on trading strategy and everything like that. This is a tool to be used with your current trading strategy, right? You don't have to change anything to use these. You take them and you implement them, right? They are a tool in which you use to support a predefined trade idea. That's what they're used for. That's what I'm making these for, right? So they're supposed to be very easy to use. They're supposed to be very simple, just like standard deviations are, right? If you know how to use standard deviations, then you already know how to use what I'm about to show you. There is just a few different caveats here. So in this thread, I discuss the difference between standard deviations and Feigenbaum constants, and as you can see, they're very, very relatively close. The Feigenbaum constant alpha is 2.5, but for the standard deviations, your main target is also 2.5. Your second target for standard deviations is going to be 4x, but the Feigenbaum constant delta is 4.669. So just a little bit more specific. Now, you might be asking, well, okay, if standard deviations are basically Feigenbaum projections, then why not just use standard deviations? Well, you can. You surely can for one single trajectory. That's the thing about Feigenbaum projections. These contain power law, which means that I'm not just projecting one trajectory into the future. I am projecting 2, 3, 4, even 5 or 6 trajectories into the future. Now, the further into the future you can try and predict, the harder it will be to be accurate. And this is due to the butterfly effect. It's exactly like the weather. This is the exact same reason why the weatherman can only predict up to 5 days out accurately. Because after 5 days, you are dealing so much so with probabilities that you might as well not even make a prediction. Right? So over time, this is what's inherent with chaos theory. With chaos theory is an inherent that you can predict things accurately only in the near term. However, it is impossible to predict in the long term. Now, this is what you will find if you try and use these projections for 6, 7, or 8 trajectories into the future. You'll find that they suddenly lose accuracy. This was expected. This is known behavior. This was completely expected, right? So do not think that that means that they don't work. That is how they're supposed to work, right? It is inherent to them that the nearer the trajectory, the more accurate you will be with it. But the farther away from the initial condition, from your measurement, the harder it will be to be accurate. All right. So you can read through this thread, and you could understand more about the Feigenbaum constants and how all of this kind of works together. But really, I'm going to walk you through everything that you need in this video right here, so you could do so as you please. Now, as I stated, I wrote a paper on this, right? And basically everything I just explained, a lot of it is in this paper. So you could go through and you can read that if you're interested. I'm working on a more formal one through my academic studies right now. It's going to be very mathematically intense, so I apologize in advance for that, but this video is practically all you need. But if you would like to read that, then by all means, go ahead. Now, before I begin getting into charts, I want to show you the settings. Now, you're only looking at these two. We're not going to talk about this left column today. We will be discussing that left column in a different video down the line. I'm still working on the left part. But in this video right now, we will be discussing just the price Fibonacci tool. So with the price Fibonacci, you have negative settings, at least on TradingView. If you're using TradingView, then you should be able to do all this fine, no problem. If you're using any other charting platform, I cannot guarantee you that you'll have the same tool settings and things like that. All this is mainly meant for the same tool structure that TradingView has. So, yeah, just keep that in mind. But for the TradingView price Fibonacci tool, there is positive settings and there are negative settings. Now, I want to make very, very clear, the positive settings are not the same as the negative settings. Do not make the negative side the same as the positive side because they are not the same. If you have both sides the exact same numbers, you're doing it incorrect, period. I see so many people that tag me and stuff, and they have their incorrect numbers, and I'm just like, it's wrong. It's wrong. Your whole analysis is wrong just because you didn't have the correct numbers. So please, for the love of God, make sure that you have the correct numbers. It is like this, right? The negative side is just 1 point smaller than the positive side, and it is like that because for the positive side, things are relative to 1, but for the negative side, things are relative to 0. So therefore, they are not the same absolute value, and you have to decrease the negative side to make them actually symmetrical. And I'll pull up TradingView right now, and we'll get an idea of what I mean. So let's say that I have this box right here, right? I have that box. Now, if I take this, as you can see, negative 0.67 and then positive 1.67. They are the same distance, right? If you were to, hold on. If you were to measure, what, 1162? Oh wait, what am I doing? 1131. So I mean, they're basically the same distance. Right, so if you have it, if I make this 1 and 2, just like the other side, you can see that's off. Right, and the reason why is because, like I said, 0 or the negative side is relative to 0, where the positive side is relative to 1. So, please, 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 please make sure that you have this correct. Reset this now. There you go. Make sure you have it correct, like this. Okay. So now, sorry, I'm just looking at my notes, making sure that I'm covering everything correctly. All right, yeah. So now, we're going to get on to definitions. Now, this is probably going to be the most important part of the entire video. It is very important that you watch this, you pay attention to it. I was not able to understand how to make these projections work until I went through these definitions. The moment I defined things the way I'm about to tell you, I was able to understand what I was saying. So please pay very close attention to this section. We're going over definitions now, and we're going over the definitions of expansion and contraction. Those are the two definitions that we're going over. All right. So the market is always expanding, or it is always contracting. Now, contraction. Let's start off very simple. Contraction could just mean any type of consolidation. It can mean a consolidation like this, right? Where it's literally just bouncing between one range of price. It could mean a consolidation like this, where you get a triangle, right? It could mean a consolidation like this. Right? All of this is contraction. These are different types of contracting price ranges, right? That is all you need to know about contraction. Contraction is very simple, very easy to understand. But then what about expansion? Well, when you think about expansion, you're probably going to think immediately about the broadening formation. Now, the broadening formation is, in fact, a type of expansion. You are correct if that's what you thought. However, this is not what always happens. Matter of fact, a broadening formation is the only type of expansion that you could see with the naked eye. Every other expansion you cannot see, at least with the naked eye. You won't see it immediately like you do with the broadening formation. So broadening formation patterns, while they do happen what looks like all the time, they're actually the rarest form of expansion. Funny enough. And it is because you define expansion as a broadening formation. This is incorrect. You do not want to define expansion as a broadening formation. A broadening formation is a type of expansion, but it's not expansion itself. To give you an idea of this, this right here, this entire range right here, is what I would define as expansion. Now, does that look like a broadening formation to you? Of course not. Look at this. Maybe you have that, but then that one doesn't hold, so maybe, I mean, like that, I guess. And then maybe you could do something like, I guess you could connect that line with that line, right? But I mean, you have zero clue if that's going to hold because you only have two levels, right? So same thing for this bottom one down here. That, like, it's not a broadening formation, right? But this is what you will mainly find in an expansion. This is what expansion looks like right here. Now, there's very specific characteristics to this expansion that we're going to find. But what you need to understand is that the market is always moving from expansion to contraction. It is always switching between those two states. And what you want to catch is, of course, the expansion, right? Nobody wants to be caught in a contracting price range. You want to be caught in an expanding price range, and you want to be caught on the correct side of it, if I do say so myself. So we're going to go back out to the monthly. Let's delete this. And that is mainly what we need to go over, right? That small little part right there was the most important part of this entire video. And I need you to go over it as many times as possible, right? You need to be able to see this. Go through, if you want, go over here to DXY and look at every trajectory, and you will find that there is a contraction at some point, and then it switches into an expansion. I know I haven't told you how to identify this expansion yet, but we are about to go over that right now. All right, so let's go back over the ES. And now let's get into the fun part. This is probably what most of you, if you fast forward past the theory, it's probably where everybody has arrived to, or probably the fib settings part, but I should have everybody's attention now. So right here, we are on the monthly. I want to make clear these concepts that I'm about to show you can be used on any time frame, but I'm just showing you the monthly because it's very easy to digest, but we are on ES. And this is, like I said, the monthly. Now, what we want to do is we want to identify where market makers or liquidity providers make that perturbation, right? That momentum ignition move, right? At that point, when they engage in momentum ignition, they perturb or disrupt the market. There's a disruption that occurs, right? So we are looking for that perturbation, and what comes right before it is what we will define as our initial condition. So I just said a bunch of big words. What do I mean? This is all very simple. Where can you find expansion on this chart? Where can you find expansion on this chart? Right here, I see expansion began. Expansion in the form of a broadening formation, right? A very rare pattern to occur, but it occurred so we could visually see it. Lucky us. And we could see that from this one finite point right here, it seems like this broadening formation began. Where in this area might we identify a perturbation? Well, I've already explained to you what exactly we are looking for in terms of momentum ignition, right? We are looking for a wrong one. You are looking for some consolidation, break, and bam, right? Where this is our perturbation. So then this will be our initial condition. Does that make sense? So where do we find that? Well, here, let's bring actually this back up one more time. What we need to find is we need to find any moment where the first high or buy-side liquidity and the first low were swept. So when we look at this expanding range right here, this expansion, where was the first high and low swept? Well, I could tell you that right here, I see one. And I could also tell you that right there, I see one. Okay. So if we take these lines and we look to the left now, let's extend this line over until we hit a candle. Now what you want to do is you want to take a box and you want to draw it around the bodies. All bodies, the body candles that fall within this range. So if I move this over, what do I see? Well, I see that there's another candle right here that still close within the bounds of this sell side and this buy side liquidity. So I'm actually going to extend this down to there, just like that. See this candle right here? It closed outside of the liquidity. So I'm not going to include that candle. I'm just going to include all the bodies that are included in this range, right? So this is the maximum of the bodies within this consolidation point. This right here is what we define as our initial condition. And this right here is what we define as our perturbation. This is where the perturbation occurred. And this is where a trajectory was formed. Trajectory was formed right here. I'm going to show you exactly how. So we have the two areas of liquidity. We have our initial condition that we've already defined right here. So what I'm now going to do is I'm going to take the Fibonacci price tool, and I've got all my settings all right here, right? So I'm going to select all these settings, and I'm now going to measure that range of the bodies. Now, why am I doing the bodies? Why am I doing the bodies? The reason I'm doing the bodies is because wicks can come in all shapes and sizes. All shapes and sizes. All it takes is one economic event to make some crazy long wick that is 5 times the size of the body. Right? But so wicks are not really important to us. They're noise. That's what wicks are. They're noise. We want to eliminate that noisy data and focus on what matters. And what matters are the close prices or the bodies. Now, what happened when I made that measurement? When I outlined the measurement of our initial condition, what occurred? Well, what occurred was it projected the next trajectory. Right? That's exactly what it did. It went up here. Once it completely filled that target, then it went down here. Once it filled that target, where do you think it went? Well, if we go up here, it went right here. Hit that, and then retrace. Where is it going next? Well, it's going to be the double, right? Or this is power law. And as you can see, perfectly there. This is what these Feigenbaum projections are. All right, so I'm going to turn these guys off because we don't need those bottom ones. Now I want to make something very clear. How am I using these targets? I don't consider each line a target. I consider each range a target. That's one target. That's another target. That's another target. And that's another target. Each range is its own target, right? I don't care about what's happening with the individual lines. The lines I don't care about. I care about how price interacts with this range right here. Right, so what happens all the way up to here? It's just pure expansion. As you can see, we stopped taking lows, right? We took a low one more time after our initial condition, and then we stopped. So what happened was the market chose a side, right? There was an expansion that began from an initial condition. The expansion was marked from the taking of the high and the taking of the low, which is momentum ignition. And then price went directional. It chose a side and expanded directionally. This is what will happen at the beginning of every single trajectory, period. Do not listen to me. Go into your charts and prove me wrong. I'm not asking you to prove me right. I am asking you to try and prove me wrong. Find when this doesn't work. And you will be surprised to find that that is actually harder than finding cases where it does. It is more difficult to find cases where this doesn't work than it is to find cases where it does. I want to make that very, very clear, and you will find that through your own backtesting. Again, do not listen to me. I could be lying to you right now. Are you really going to believe me? I could be lying to you. All for views, all for clicks, all for money, all for engagement, all for follows. How do you know? I'm just some random person on a bird app. Well, actually, I guess now it's an X app. And no, I'm not talking porn. I don't know why Elon named it X. It's terrible. Should have kept it the bird app. Getting off track here. Grinding my gears. Now, this is what we defined as exponential expansion. Right here. This is the entire basis and premise of the model. Now you will find, so the 1.67 or the 0.67, these two ranges are the first ones. They are our first targets. And you will find that the first targets will always be the most accurate. The second set of targets, it will begin to deviate. By the third, you could see large deviation. In this case, we didn't see much deviation, but in other cases, deviation could mean that it went above it by X amount, and then it finally reversed, right? So there was that would mean that there would be a, 1762 deviation, right? So over time, the further out you try and project, the more price will deviate. And this is due to the butterfly effect. Again, this is completely expected behavior. This does not mean that it is broken. This is what is supposed to occur. Now you're probably thinking like, wait, so I can't use then these targets long out into the future. No. You can use them long out into the future. My point is, you constantly are going to need to make new measurements as new trajectories form. So when you look at this chart right here, where can you see exactly what we just did right here? Over here. Where can you see it next? Right? Where's the next moment it happens? The very next moment. Well, as I just showed you, if we delete all this, clean up our charts a bit, we are looking for momentum ignition. I can see up here, something occurs fractally. Now, you have to learn to read candles. Well, what's happening candle by candle, right? And what do you see here? Well, you see, if we zoom in all the way into this price range, right here, we see that a high was made, then a retracement. Right here, a wick broke below that low, broke above right here, and then it came back down again, breaking below this low. So I can suspect that this right here is going to be my initial condition. I can suspect that. However, I cannot get a good glimpse of where sell side and buy side was taken here. So what should I do? Whenever this happens, whenever you think you see a trajectory but you can't see it on your time frame, that's when you go down a time frame. So we're now going to go down to the weekly. What do we see over here on the weekly? Well, we see something very interesting. We see right here, sell side. Right here, buy side. Now, how crazy is it to say that this right here was the beginning of the trajectory downwards? It still went up, right? No, this was the beginning of the trajectory downwards, and I'm going to prove it to you right here. Again, let's take this and let's bring it all the way out. Where are all the bodies that close within this range? It will be right here to right here. These are all the bodies that close within this range. See right here? Yes, the body was in this range, but where did the wick go? It went out, right? So everything that closes within these two lines right here, all the bodies, right? Full candles, everything's bounded together with this initial condition right here. So what am I going to do? I'm going to take my Feigenbaum projections. I'm going to make a measurement. Again, it projects right here. Then it projects right here. Now, your initial condition. So what I say before, I said that this right here, this range is a target. And I also said that this range right here is a target. Now, there's one more target that you see right here on this chart. And that target is the initial condition itself. The initial condition itself will act as its own supporting range. So, hits that, comes down, hits that, bounces, goes down there, bounces back up, goes up here, bounces back down. Where do you think it's going next? Where do you think it's going next? Going right there. Going right here. That's where it's going next. And what happened when it got right here? It retraced and went back to this range before going lower. Now, hold on. What the fuck? Yeah, there we go. And at the very bottom, barely tapped that 7. So as you can see, the further out we try to project, we finally got that deviation, right? It didn't fully fill this range. It deviated and it just barely hit that line, right? Further out you go, the more it will deviate. Again, this is inherent to the projections. Now, what happened down here? A new trajectory formed. A new trajectory formed. Where did the new trajectory form? This is a live exercise. If you are watching this right now, pause the video, look at my chart, and think deeply about what I've just discussed. Where did the trajectory form? Well, it's not really that much of a trick question because I actually showed this earlier. Yep, sell side. It. And you have buy side. This is where sell side and buy side was taken. So believe it or not, a trajectory higher began right here. Right here. This is where the trajectory higher began. Our perturbation is this guy right here. Or sorry, no, I lied. This guy right here. This is our perturbation, right? Lows were taken and highs were taken. This is the momentum ignition that we were looking for. So you could see that this is the area where large institutions, corporations, hedge funds are going to be building up positions to take higher. So again, where is the consolidation that came before it? It would be this initial condition right here. There's the bodies that fell in between these lines. These are the only ones that were able to stay within those bounds, right? What am I going to do? Take this, that, bring it right over. Now what happened? What happened? What happened was we filled that range. We enjoyed the initial condition for a bit, just bouncing off of that. And now we're taking it to this range. So where can we expect it to go now? We just took it here. Well, there's a few things that could happen now. One, it could literally bounce right here and continue up higher. Just like that. Just barely leave the range and just continue higher. Or we're going down to somewhere in this range. Or we're going past that. However, if we're going past that, that doesn't concern me. What concerns me is where we're going next, not where we're going far out. I don't care where we're going 3 trajectories from now. I care where we're going next. So really, there are 2 options. There's only 2 options of where price can go. And it's, we get a reversal now, we continue this madness higher, or we take the more reasonable assumption in which we're going to get a retracement to at least our prior target, which was our initial condition. Does all that make sense? As you can see, this is very simple. Once you get the hang of it, there's not a lot of moving parts here. And it could actually all be broken down into a 5-step process. Right, so let's go over these steps one more time. That way you have them very clearly defined for you. Step 1, identify the perturbation. How do you do that? Liquidity was taken there. Liquidity was taken here. This is actually buy side liquidity, not sell side. So where's our perturbation? From this low to this high. That is our perturbation. So we have identified our perturbation. Step 1, complete. Step 2, identify our initial condition. How do we identify our initial condition? We extend these lines from our perturbation, and we say, okay, let's denoise this range. Let's remove the wicks and let's focus on what matters. In doing so, we'll leave you with this range right here. Step 2 is now complete. The initial condition has been identified. Step 3, confirm that our measurement is correct. Well, how in the hell do we do that? Well, if our measurement is correct, right? Then when we make it, we should get alignment. So, when you see this perturbation occur, and you make a measurement, and you see here, barely hit our target. Here, reach our target perfectly. You could say that using both sides of our perturbation, right? Both sides would be right here. That would be one side of it. And the other side would be right here. Both sides of your perturbation should align with your first targets. If they align, then step 3 is complete. You have confirmed that your measurement is correct. Right? So again, we could do that with this side as well. Where was our initial condition? It was right here, right? It was this area right here. This was our initial condition. Oh wait, no, not that. It was this right here. It was that area. So if I make a measurement right here, like this, I could see it hit this side, and then it hit this side right here. So let's remove these. Like that. So if we are, let's use a replay tool here. Let's say I am right here. Let's say I'm right here. How do I know that this measurement is correct? Well, again, our perturbation right here. Again, both align both sides of the perturbation. Right here, wicks hit zone 1. I could say with confidence that this, it respected. Then we come up here to our next target. It hit that. Both sides of the perturbation matched up with our targets. We now have confirmation to take our trajectory to our next targets down, which would be these ones right here. So it hit this side of our perturbation. It hit this side of our perturbation. Step 3 is complete. That is our confirmation. What then occurs? Bam. You can see again, you could get a third confirmation that this is correct because it continues. Right? So then you could then take it in the direction of wherever your next targets are. In which case, being right there right now. But we also reach a bit with the wicks into that one right there. Right? So you're taking it from target area to target area as you go, and you confirm it with that one. So you have confirmed that your measurement is correct, right? Step 4, create your targets, as I just did, right? And step 5 would be going down to lower time frames and entering. So it's a very simple mechanical framework for projecting what I have defined as an exponentially expanding range. And I've defined this range very precisely, very specifically, in detail. And it should be very, very consistent throughout in how you identify each and every range that you approach. Again, this is fractal. You can take this into the daily time frame. You take this into the hourly time frame. You take this into the 5, 15, the 1 minute time frame. However, across the board, you technically only need one single time frame. You don't need multiple time frames to trade with this. If I take a measurement on the monthly, then I could use the daily as entries and continuously use my monthly targets for a direction, for a bias. And I could just take trades in the direction of my monthly target. Right? If I have a daily target, then I could take hourly trades in the direction of my daily target. Right? So you technically only need one single time frame to use this on. let me look at my notes really quick, make sure that I'm covering all points correctly, forgetting any information or leaving anything out. All right, so I've explained the butterfly effect. I've explained how over time our trajectories, they diverge if we try and let them go for too long. And therefore we should be constantly making measurements for new trajectories whenever we see them form, right? So we've done 3 total measurements thus far. We did a measurement going from here to there, then from here to there, and then from here to there, right? So as of right now, we're in our target zone, right? If we go on the weekly, because this is where our measurement was, it was right here. So I don't see any Judah swing that has occurred right here. I don't. However, if I go right here, what do I see? Well, I see that there was a consolidation. There was buy side right here that was taken. However, I haven't seen any sell side taken. There's been no Judah swing yet. If a Judah swing is to occur, if our perturbation is to occur, it would have to be something like this. Does that make sense? So what I am doing right now is I am anticipating the formation of a perturbation. Now, this is a powerful tactic to use, but it is dangerous at the same time. And this is why. As I've stated, step 3 in the process is you confirm your measurement as accurate. And the way that you confirm it is by using both sides of the perturbation. We have not seen the perturbation occur yet. We've only seen one side of it. If we make this measurement, I can say with reasonable confidence, like, okay, so I could say, okay, well, we respected this side. Are we now going to make our perturbation and reach this area? Well, when I say that, and I have not seen the perturbation occur, I am dealing now with probabilities. I'm not dealing with certainties. If we can confirm our measurement as accurate using both sides of the perturbation, then we can be certain. Again, this is chaos theory. This is inherent to chaos theory. We can be certain that our targets will be correct up to a certain extent. So because the perturbation has not occurred yet, I'm not dealing with certainties. I'm dealing with probabilities. I'm taking an educated guess. I'm making a hypothesis. With that being said, this can be powerful to then take it from here all the way down to here. That can be very powerful to do. That can be a very powerful position to get into. However, it could also be very risky. Because if you're wrong and it reverses on you and you're not paying attention, it could take your account the complete opposite way. So, try your best to not anticipate the perturbation happening while you are still learning this framework. Once you get the framework completely down, once you have it mastered, that is when you could expand into, okay, how can I anticipate this from happening or before it happens? Do not do that until you have this framework down and a full understanding of it, because you will fail, I promise you. If you try to anticipate these perturbations, you will fail unless you have the framework down. It is easiest to anticipate the perturbations, though, using higher time frame targets. As you can see, we are in our higher time frame target zone. Therefore, if we are to get a reversal, we should see a perturbation right here where a new trajectory forms, and we take it down lower to, well, it would be this target right here. Does that make sense? See how they align perfectly, right? This is exactly how it's supposed to work. You align lower time frame trajectories with higher time frame trajectories. So that would be anticipating perturbations. Now, I want to hash over this one more time because it's actually very important. Study what is happening right here in this range on the monthly. Get very good at knowing what is happening on a time frame lower than you're currently on. Right here, I could see that a trajectory has formed right here, even though I cannot mark out the perturbation on my current chart. This is something that you're going to really want to get good at if you're going to want to know where trajectories form and how often they form. You need to be able to see them forming on lower time frames. So I can see right here, a trajectory is formed. And you can actually mark it out on this one. You could see a trajectory formed right here. Buy side was taken by that wick. Sell side was taken down here. Now, making a measurement on this time frame is going to be completely different from making a measurement on the weekly time frame. If I were to measure this right here, this body to this body, right? This would be our initial condition right here. You see that here, we barely wicked the bottom range, whereas on the weekly, when we made this measurement, we completely filled it. And that's because the bodies are wider. If we go down into the weekly, we could actually see that the initial condition that we highlighted on the monthly is larger than the initial condition that we would have highlighted on the weekly. That's the one that we would have done on the weekly. And that's the one that we did on the monthly. So see how they're larger? There's a difference. However, both of them were still relatively accurate, right? When we make a measurement right here, we could see that there was actual alignment within this range right here, right? That range is a range that was completely fully aligned, right? So viewing when trajectories are forming on time frames that are different from where you're currently on. That's all extremely important to do. Now, we're actually going on an hour and 50 minutes right now, so this is actually taking longer than I expected it to. So sample top-down analysis procedure. I kind of just went over that, but we'll go over it again. Right here, we have a measurement. And up here, this is where we see our next trajectory form. We go onto lower time frame. And doing that, we can see our initial condition over here. And we can now take that lower down here. So this is where things get a little bit messy. These lines, they get everywhere. It's a little bit frustrating, actually. But they do get everywhere. So you're going to have to keep your lines as clean as possible. And the way that I do that is by only keeping what I need on my chart when I need it. So for example, if I am right here, do I need all these lines? No, I don't. I could remove all of these up here. I don't need. So I'll remove those. Those. Remove all those. And then those two bottom ones I don't need. Really, these are the main ones I need right here. So this is how you keep your chart clean while you're doing these. You want to adjust for what you just need to see right now, right this moment. Right? So doing that, you get more clean chart drawings. You could also remove what you used previously and don't need anymore, right? So you could probably get away with removing that one and just focusing on something like this. Isn't that crazy? Isn't that fucking crazy how perfectly that hit? Pretty wild, actually, when you think about it. So I think this would be a great time to now segue into another phenomenon that occurs with these projections. So going back to the theory, what have I stated? Price is a function of liquidity. Well, liquidity is basically another measurement for orders, right? Because the amount of orders placed is going to be somewhat proportional to the amount of liquidity that is coming in and out of a market, since orders require liquidity, right? Well, if everything is based around liquidity, then you should be able to quantify this in some form, some fashion, right? You should be able to use some measurement of liquidity to confirm that what I'm saying is correct, right? Well, if this is an initial condition, how can we confirm that? Well, one tool that we have on TradingView over here, we have something called the fixed range volume profile. Now, the fixed range volume profile, I personally don't trade with volume. I don't trade with indicators or anything like that. But this is pretty interesting. If we set right here at the beginning of our initial condition, and then let's do the entirety of our perturbation, right? So it would be up here to down here, right? It took that liquidity, so that would be, you do that. What you'll find, look where it aligned perfectly with, if we turn that one on, you can see that it aligns perfectly. Now, if we extend this further, we'd actually get some pretty interesting results. Let's just do it to the high. Same thing. What if we do it? Oh, wait, whoops. All the way to the low. Interesting. We keep getting the same area as our next perturbation. Continuously. It keeps pointing in the same area. Well, what if we change it up now? This is where perturbation was. Now, starting from the beginning, go down to here. Well, interesting. For one, it aligns with our prior initial condition. Remember where I said the next target was? It was somewhere down here. And two, we go down into the daily, and we now take our measurement. Well, we could see that this is where it is, down here. That's where it goes. Which is pretty close. Pretty close. It's not fully accurate, I know. But like I said, there's deviation over time, the further out you try and project. So with the volume profile, things get very interesting, to say the least. You could also use something like the, if you go over here again, and you'll see the anchored VWAP. Again, I'm not a fan of the VWAP. I'm not a fan of indicators. I don't endorse indicators. But for people who are trying to get an idea of what exponential expansion looks like, you could start right here. Bam. This is using, whoops. This is just using the band's multiplier of 3 with the HLC 3 close settings. This is a very good visualization of what I mean by exponential expansion. This is an exponentially expanding range. We look over here to this initial condition right here. That would be an exponentially expanding range, exponentially expanded to the downside. Right? You see that? See how you wouldn't have seen that as a broadening formation. But what that is it's exponential expansion from a single finite point. A single finite point right here. Oh, wait, shoot. Right here. Bam. Exponential expansion from a single finite point. Just different ways of seeing the same thing. That's all it is. All right, so we've gone over a lot of different things here, and I think I'm going to cut it here soon. I'm going to leave out a few things just because this video is way beyond what I thought it was going to go to. But I feel like we've covered a lot of good points. But the things that I think I'm not going to be able to cover are the use cases. What I was going to do was I was going to go over 4 different strategies. One strategy is by someone named Phantom_ICT. He has a 940 Judas swing model, or basically he's identified a perturbation that occurs every day at 940 very consistently. And he's built a model around that. I was going to go over the market maker trader. He has a model regarding market maker profiles. I was going to go over the mentorship model by ICT, and I was also going to go over the strat by Rob Smith. I think I might have to do a different video on all 4 of those, because those 4 things alone could take an additional hour at the minimum. So I think that just leaves me with a few different points to make. The first one I want to make is about issues that you might encounter. As I've already stated, there are going to be times where you need to get good at viewing this happening from higher time frames. Because one issue that will occur is you won't see a trajectory form when it actually has. This you can solve by getting good at fractal analysis. Doing what I just showed you right there, seeing the perturbation and the initial condition on a higher time frame, or on a lower time frame even, than the one that you're currently on. That will solve that issue. The other one, I know people are going to have an issue with this. Identifying the consolidation, the correct initial condition. I need to put emphasis on this. Where was the first sweep? It was right there. So what I'm going to do is I'm going to take this line and extend it out. Once I extend it out, where are all the bodies that fall within that one and that one? That's how you identify your initial condition, period. It's consistent every single time. You find the high, you find the low, you extend that over. Where are all the bodies that fit within that before the perturbation, right? I am not counting like this candle right here, right? Because that's a part of the perturbation. I'm using just this range, and I'm calling that my initial condition or my initial consolidation. I know people are going to have an issue with this, but I need to put emphasis on how you identify that consolidation, because it's very specific, it's very mechanical, it's very straightforward. You should be able to see it very easily. Get the hang of it very easily over time, at least. Now, those two things are what people are going to have the biggest issue with. The third one is going to be actually getting measurements aligned. I know that people are going to be experimenting, figuring out how to make these measurements the most accurately, and just use the bodies. And the key is defining your initial condition. You could be one single candle off, and that can make or break your measurement. So it's going to take some playing around with, it's going to take some back testing, and it's going to take some getting used to. But once you get the hang of it and you've gotten enough experience under your sleeve of making measurements, you'll start seeing a pattern on how you measure, right? It's very mechanical, it's very logical and straightforward, and you will see that pattern if you do this enough times. These measurements can work on every time frame. As I've already stated, they can work in any market. Crypto, Forex, stocks, futures, you name it. All of them work. The biggest thing that I need help with, how can you help? If you want to be a part of this, if you want to help grow this, you want to help expand it, how can you help and be a part of this? Well, what I really need help with, one, when I make a measurement such as this, one thing that I am trying to figure out and have not been able to figure out yet, how do I choose what range price is going for? Right? Why didn't we go here? There will be times that you will find where price might just expand right through a target and go to the next one. And my biggest question is why that happens. How am I able to find somewhere on this chart some piece of information that tells me, okay, when I make this initial condition, right? When I have this initial condition and we hit that and we hit that side, if I am right here, right? If I am right here, there are a few places that we could go. We can now shoot all the way down here, and we could go to this range right here. Or we could go just to right here to that initial condition. Or we could go to this one. There are 3 potential trajectories at this very moment, and I don't know which one price is going for. This is something that I'm really trying to figure out. And I know there's an answer for it. There has to be. Based on the theory and how everything's worked so far, there has to be an answer to this. What the answer is, I am not sure. I can take all the help I can get. If you have any ideas on how to figure out if we are currently in this moment, how do we determine which trajectory or which area to target. I think that's the biggest question that needs to be answered with this, and that's the biggest way you could help. Other than that, there's more that I haven't revealed that I will be revealing soon. Follow me on Twitter, subscribe here on YouTube. I'm very busy, so I don't make videos often, but I'll make a few more on the price projections, and then I'll make a few more on the time projections, and maybe I'll make a few videos dedicated to entirely the theory. But for now, this will be my introductory video of everything, and please leave comments. What did I explain well in this video? What did I explain absolutely terribly? If I explained something terribly in either this video or my thread on Twitter, give it to me in the comments. Tell me how terribly I explained it, so that way I could fix it in the next video. If you do not tell me what I need to improve on, it will not be improved. So I need you to tell me what I've done good in this video at explaining and what I need to explain further to help you guys get a grip on and understand. Of course, these are still in development, so things can change, but what I've shown in this video is pretty much concrete. I've been using this for months now. I haven't had any changes to the framework. Everything's been consistent this entire time. I've had many people backtesting this. The results are phenomenal. So I think it's time to open source this and get this out to people and figure out what more people think of it. But I will be making more content on this in the future and giving you guys more updates and giving you guys more tools that you can add to your arsenal, because this is by no means it. If anything, the reason why I am releasing this one first is because it's, believe it or not, it's the worst of them, which is kind of crazy to think about, but it just shows you how far along this theory has come and why I'm so sure that it's accurate. But my goal isn't to convince you. My goal is submit the evidence. Let you convince yourself. Because I'm not going to convince you. I could tell you right now. I could give you any story on the book. I could tell you that I've bought a Boeing 737 using this strategy. I've bought 15 cars. I'm 22 years old and I'm self-employed and blah, blah, blah. I've made all this money. I could give you every story in the book. My word doesn't mean shit. Pull up your charts. Take what I've said. Rewatch what I've said. Study what I've said. Read what I've written on Twitter. And test it yourself. Prove me wrong. Don't test it to prove me right. Test it to prove me wrong. And you will find that will be very difficult. So I wish you well doing that. With that being said, it is midnight where I am. So I'm going to have to cut the video here. We are now going on 2 hours and 15 minutes. So thank you everybody for watching. To recap everything that we've gone through theory, we've gone through the paper, we've gone through a few of my Twitter threads, we've gone through how they're similar to standard deviations, we've gone through the definition of expansion and contraction, we've gone through the Fibonacci settings, we've gone through the 5-step process, we've gone through examples. We've talked about anticipating the perturbation. We've discussed the butterfly effect. We've discussed identifying fractal trajectories. right? Viewing things from a fractal perspective, seeing them take place on smaller time frames below you. We've talked about combining trajectories. You take one trajectory to the next, and over time, you make measurements as you go. And I've explained that the top-down analysis process is very simple. You only need one time frame for the measurement and one time frame for the entry. That's all. And you can take this all the way from the monthly down to the 1 minute. You just need two time frames, just one for the projection and one for the entry. And that's all. So that's the top-down analysis procedure. It's very simple, right? We've talked about the issues that you might encounter with this. I've discussed keeping your charts clean, right? Removing the ranges that you don't need. There's one more thing that I want to point out, actually. Well, we have these ranges. I have names for them. This will make it easy for you guys to reference. I have names for these, right? So if you see me post a chart on Twitter or something, then you know what I'm referencing. But each of these targets, right, they're their own ranges. There's the positive side and the negative side. So when we're looking at this, the initial condition, which will be right here somewhere, right? This I will call IC. I'll call this IC, all right? For positive fibs, I'll call this F1. I'll call this F2. And the third one, I'll call F3. Right? F1, F2, F3. Now there's a negative side, the negative one. I'll call it negative F1. Negative F2. And negative F3. So if you ever see these on my chart, or if you're ever trying to reference a specific target area, these are the names that I've given them, all right? Negative F1, F2, F3, positive F1, F2, F3, and IC for initial condition, all right? Those are all the abbreviations. So if we're keeping your charts clean, remove the ranges you don't need and reference them by name, right? Only keep what you have on the chart as your next target, right? Whatever you're looking at for your next target, just have those on. But everything else beyond that, take it off. Make your charts clean. Make it easy to understand and see. Visibility settings, you know? If you're doing multi-time frame analysis, only have these visible on the time frames that you're going to be using them, right? Make it easy to see, interpret, and understand. So we've talked about keeping your charts clean. We've talked about how you can participate and what you can help with. And I think I mentioned that we've talked about issues that you will encounter, right? Making the actual measurement, identifying the initial condition, viewing things from a fractal perspective. Those are all issues I know you guys will have, but I've told you how you could deal with them and work through them. We've gone through everything that I have mentioned in my Twitter thread, except for the 4 use cases, which I will go over in a separate video. With that being said, I hope that this video made it easier to understand everything that I've discussed in my thread. I hope I've broken it down well. Again, please give me reviews on what I didn't do well. So again, it is midnight. Thank you for watching, and I hope everybody enjoys what they've learned. And please follow me on Twitter. All timestamps are in the description, and I will see you again soon. Good night, everybody.